Hi, I'm Mark Honeybone from Property Ventures, and welcome to our weekly podcast where we interview prominent members of the investment community along with other professionals in the New Zealand property market. This is a free service from Property Ventures so that you can keep current and learn from some of the best around New Zealand. To check us out, take a look at propertyventures.co.nz. We hope you enjoy today's podcast. Hi and welcome back to the latest New Zealand property podcast. So banking, interest rates, Reserve Governor, OCR rate have all been in the press a lot lately, and we've never had a bank on the podcast so far. So today we've got BNZ in Auckland to come and talk to us. So we're lucky enough today to have Stephanie and Jeremy from the BNZ. Stephanie's a senior partner in Newmarket BNZ Partners in Central Auckland and leads a team of business bankers. And Jeremy is a sales manager for residential property investment based in Auckland, and he's had years and years of experience dealing with investors, and a lot of you may have come across them before if you happen to bank with the BNZ. So hopefully during this interview we'll ask all the questions that you're out there wanting to ask and find out a bit of the inside of how a bank works and why they come up with what they do. So sit back and listen, and I'm sure you'll enjoy. So welcome to the show, Stephanie and Jeremy.
Thank you.
Thanks.
Great to be here.
Okay, so listeners know who's talking to them today. Can Stephanie, you tell us a wee bit about yourself and your background?
Yeah, thanks, Mark. Thanks very much for having us on the podcast today. So I've been in the financial services industry for almost 20 years, the majority of the time with BNZ, and over that period I've had mainly frontline roles and led a variety of different sales teams, including a team of mobile mortgage managers. For the last year and a half, I've been leading our Central Auckland Business Banking Partnership based here in Newmarket in Auckland, and prior to that, led the team in South Auckland.
Great stuff. Well, it's good, 20 years experience. So I said at the start, Jeremy had lots of experience. You might have had a bit more than Jeremy.
Just a little bit.
Yeah. So Jeremy, tell a bit about yourself. And I know we've actually met before in previous days when a business partner of mine was talking about this great service he was getting from a bank. And as it happened, it was you, and then a few years later, here we are again.
Yeah. So I guess for myself, I've been within the financial services industry since 2003, and with BNZ for all that time as well. For the last sort of 6 years, or since 2010, I've worked within the property investment team in a number of different roles, right from customer-facing to a more business development type role. And then in the last couple of years, I've now become sales manager for the property investment team.
Great stuff. Okay, so let's get straight into here. And one of the first things is how the main banks and branches work together. We'll get on little bits of policy a bit later on, I guess. But how are all the branches on exactly the same rules and what have you with the banks as they bring new rules out?
Yeah, no, it's a great question, Mark. So at BNZ, I guess just to talk a little bit about the housing market. I mean, we've got a significant investment and focus on the housing market, and that's right across New Zealand, but particularly in Auckland, as we know, with the growth and the migration growth and the population in Auckland. We've put a lot of resource into actually assisting our clients in that particular market. But just to give you context, BNZ's got over $30 billion of funds under in assets in the housing market. So
right.
That's loans out there to the marketplace. So it's a significant amount of our balance sheet. And just within sort of the Newmarket partnership, we've had a 25% odd sort of growth within the past year. So it really is quite a busy time. And nationwide, the entire company's seen that sort of growth. But we've got 167 branches around the country. We call them stores. And I can let Jeremy tell you a little bit about how his team will actually interact with the branches and the people based in those locations.
Right.
Yeah, so I guess branches, they have a wide range of knowledge and products that they have to try and help customers with on a day-to-day basis. So one of the things BNZ's done, and it's a unique sort of proposition to the marketplace, is we have a dedicated residential property investment team. So what that really means is we've got a team of specialist lenders who sit either within an Auckland central-based environment or out on the road, and they're talking to property investors every day, all day. So they get to understand property investment talk. They speak investors' language. They'll talk to them around things like gross versus net yield and different sort of level of conversation you might not otherwise get from a day-to-day banker.
Yep.
That's not to say that some of those bankers out there can't have that conversation. It's just we can control, obviously, that within our team.
Absolutely. Well, 30 billion's worth of funds in property. As a bank, you know what you're talking about, and you've got an invested interest as an investor has.
Yeah.
So if you are just selling your own home or buying your own home, I guess, and you're somewhere else around the country, you deal directly just with your local bank. If you're an investor, what stage do you get to the investor? I suppose experts within the bank. When do you go out of the local bank into maybe talking to someone like yourself?
Yeah, so Jeremy's team can handle investors with quite a large portfolio. Once it starts to get more and more complex in terms of the borrowing needs and that investor's actually running it like a business,
Yep.
That's probably when they would actually hand over to BNZ Partners, and one of the, like someone within my team, a business banker, would actually then take over that relationship, and that would be more of a dedicated one-on-one person.
Yep.
And the benefit of that really is that they've got lots of knowledge again within that sector. They're seeing different clients and how they behave, but they'll also be able to provide advice around different structures, different products, and the needs are just a little bit more complex. So once they're running it like a business, they'd come into our team. We've also got the next level up around developers. So we've got a property finance team who would be looking at big sort of large-scale apartment buildings, subdivisions. So when you're into the development stage, we'd bring them in to offer their expertise. And then also under the BNZ Partners umbrella, when a property investor may get to the end of their life cycle around, they've paid down a lot of debt and they've actually got a lot of equity within their portfolio, they may be looking at more that passive income and how they want to actually invest that.
Yep.
And we can actually then introduce them to someone within our private banking team that would be able to assist them perhaps on how they want to maybe diversify that investment and portfolio, and offer some advice. And they're all AFAs, which is authorised financial advisors, and they can offer that specialised investment advice. So really, wherever you are, sort of, whether you're a small one or two properties, or whether we've got clients within our portfolio that have 25 million of lending. So whatever your size or scale, there will actually be someone within BNZ that can actually work alongside you to achieve what you want out of your investment portfolio. Yeah,
and that's great. So obviously the whole spectrum's covered from the investor right through, as you said, which is important. And we've got listeners in all those sort of categories that are listening to this sort of now. So in the last couple of years, we've, with what you're saying there, for what sort of category or level you go up to the next sort of person, I guess some people, be a lot of changes obviously in banking in the last year or so, and people talk about you had $1 million or $2 million or 5 properties before you went up to business banking. Is there a set rule as far as the bank's concerned, or does it depend on the individual customer when they go up from the basic banking to residential stuff to the next level?
It's very much case by case, and really comes back to a number of different factors. Their current portfolio, what their strategy is. Are they looking at a real growth-based strategy and looking to acquire a number of properties quite quickly? Are they looking to diversify into different property types, your commercial, your mixed-use residential type properties? Because each scenario can then require a different level of expertise, and we want to make sure we're putting our customers in front of that right person as early as possible.
Right, okay. And the other thing that's been going out in the last couple of years in the finance world, and we still, from the other side, who aren't the experts in the field, probably shows some concern, is you'll get people saying when you get to 5 or whatever properties, you go to business bank and then you're only going to get 60% lending next time round. Is that just a myth, or how's that sort of work? Or again, does it come back to case by case situation of the investor, which I imagine it possibly does?
Yeah, it does. And the LVR, the loan to value ratio, is something that obviously the Reserve Bank compliance that they put on to all the banks that need to adhere to that, and obviously the Auckland markets, they've treated that slightly differently as well.
Yep.
So general rule of thumb is that that same scenario will occur across all of whoever you're going to deal with within the bank. It really comes down to the case-by-case scenario for each individual.
Okay. No, that's all good. So, perfect. So speaking of the reserve governor and the OCR rate, obviously that comes out every couple of months and everyone's sitting there about after 9 o'clock listening to see what's going to happen, as I imagine you guys do too, or maybe you already know, I don't know.
Definitely not.
Definitely not. So what happens then from the bank's perspective? Because some banks jump straight away, some banks don't do anything for a wee while. What happens in the banking world when that happens?
Great question and quite topical. I guess there are a range of factors that impact if a bank increases or decreases its interest rates. One of those is the official cash rate. The other piece to that is offshore cost of funds, and currently we're in a rising market in that space due to it being more volatile offshore. So I guess irrespective of the stage of the economic cycle, is a good time for people with home loans and lending to consider their position and where they fit, to understand if they're making the most of current low interest rates. I guess when you're talking interest rates of low to mid fours, historically that's a very strong position to be in. So what are they doing in that space to ensure that sets them up moving forward? Are they paying down debt faster, or are they using those funds for savings or surplus cash flow, or to put towards another investment that they've got in mind further down the track?
No, absolutely, and investors out there, some are going to need to jump straight away when OCR rate happens, or what the area of the advice might be, and other times it might not be a massive drama, or probably like now, well, in my opinion, I think the rates are reasonably settled at the moment, so they carry on there, whatever they're doing. But I suppose that relationship with a bank then becomes paramount with what they should be doing, because you guys got the experience, I guess, of what's going on and what the individual situation is, more so the individual sometimes.
Yep.
I think. Okay. So at times, what I found really confusing is banks seem to have different amounts they can borrow. And what I mean by that, you'll go into a bank one day and there will be unlimited, or appear there's unlimited funds for someone to borrow, and then other times you'll go in when it seems everything's fine and you can't get a loan. Do you want to put the BNZ's perspective on that, or maybe on behalf of all banks? I guess all banks are different also.
Yeah, really good question, and we do get asked that a lot, where someone's worked it out on the back of an envelope on a 4.5% interest rate, and this is the property I want to buy. I think I could borrow this much. Why does it not sort of stack up in terms of the bank saying that's the same amount? So there's a number of things that we'll take in factors in when we're considering a loan application. It would be the type of asset, the area that it's purchased in, the mix of the portfolio as well, the customer's history, and past experience and current portfolio. Obviously, we take into account the ability to make the loan repayments, and often an investor may work that out on the current interest rate and a lower one. We use an average interest rate, so that if interest rates do go up, the client's actually still able to make their loan repayments. So we're not looking at just the next 12 or 24 months. We're actually taking a long-term view, and as a good lender, we don't want clients to get into difficulty, so we will use an average interest rate. And also the servicing criteria is obviously a critical thing. So you may have lots of equity, but not have so much servicing. The two go hand in hand. We're not just equity lenders. We need to make sure that the loan's been able to be serviced, and therefore, again, we will take a conservative approach often in sensitising the rental income. But if the property was vacant, then you're still able again to meet those loan.
Is there a standard rate? Is it 75% or of the rental rates that you use, or is it again case by case where the property is?
Again, it's case by case demand. So Auckland again would have a higher demand for that rental than perhaps somewhere out of Auckland. We'll also look at whether you have other income, so a partner, or whether you're salaried or whether you're full time working on the business. Because obviously, with a salary, there's a fallback position there as well. Should property be untenanted for a period of time, you can make all of those. So, and the interest rate's just that a number of factors that are in that whole mix as part of the calculation. One of the other important things is actually looking at how you structure your portfolio too, around when your loans are maturing or coming off, that you haven't got them all coming off at exactly the same time, that you're actually spreading that risk across, maybe having some on a 1 year fixed, a 2 year fixed, a 3 year fixed, and then you're reducing your exposure to something changing in the market as well.
Yeah, sure thing. I think what a lot of listeners, or some listeners won't be aware of is, as you said, you get your current rate, whether it's 4.25 or whatever it might be, which is fine. Everyone, or a lot of people think that the banks will use that, as I said, for the calculations, where for obvious reasons, you just said, that's not the usual for the next 20 years. And if I suppose you're writing out a 20-year or 30-year loan, you have to be safe and average it out. So I know there's a lot of listeners don't know that's the case, that banks use those higher rates.
Well, if you're new into investing, then these are historically low interest rates. But for those of us that's been around a little bit longer, there have been it's not uncommon to be in the 10, 11, 12%, and so you want to be able to absorb that shock should something like that actually occur, and not be forced to sell properties at a lower rate than what you'd be prepared to accept otherwise. And I think, Mark, one of the key things that clients can think about when they are talking to their bank is actually about having really good information. So if you're using some sort of a financial system to do your accounts, or even if you're spreadsheet checking it, or those things, then the more information that you can give us actually really does assist, and also speeds up that turnaround time that we're able to provide you. So just be as open as you can with as much information.
Yeah, no, exactly. It's not worth hiding anything that they'll want to come back and bite you in the end anyway. So on that point, what can investors do to help their cause when they get lending? It's a pretty open question, I guess, but first of all, from probably a servicing side, I just found out recently on a situation where if someone had virtually no debt or very little debt and a good income, what they could service was massive compared with a person that had a whole lot of income, a whole lot of assets, but quite a bit of debt at the same time, and a similar sort of wage. The person with no debt could actually borrow more. So what sort of bits and pieces can people try to work towards to get greater lending?
I guess it all comes down to what their total strategy is, what they're looking to do. First of all, it's taking your relationship banker or your bank as a whole on that journey. So I think a lot of customers need to take a step back and actually think about what they're wanting to get out of purchasing a property. Coming down to an individual and what they can actually service. Stephanie touched on it before, where servicing and equity go hand in hand. That you can't have one without the other. But at the same time, we need to ensure when we're looking at any lending application, everything is acceptable across all those elements. We're not equity lenders. We don't want to put someone in a position that we don't feel they can make those repayments. So it's just making sure that you put yourself in the best possible financial state when you approach a bank and you have that information. So maybe that's reducing any short-term debt you have and the like.
Yeah.
And that also might help when they're looking at the strategy of what type of properties they're looking at, whether they are what sort of yield, or whether they're the cash flow positive, or whether they're actually doing a capital gain, longer term hold that might give upside down the track, but the cash flow is a bit tighter. And working with your accountant on those type of things will actually help with your strategy.
Yeah.
So you know where you're going.
Okay, so then you get the investor that are about to go into the bank and try for some finance. You said there you can get stuff from the accountant and your documents from the accountant to back up your situation. I remember going 10 odd years ago, going to property education seminars in schools, and they talked about the interview, going to see the bank and dress well, and and have all your, as I said, all your documentation neatly presented, and maybe a picture of the house you're trying to do. Is that all just sales talk from a presenter, or is that actually does that help in the when you come to doing an interview? What would you require, or what would make it more favourable for the person wanting to get some money?
I guess, great question, and one probably doesn't get asked that much. No, you don't have to come up all dressed up in your suit and your tie. Those days are gone. But certainly being prepared for the interview, having all your relevant documentation across, income statements, what you're going to get, how to rent for this property, your plan for the property. Stephanie sort of touched on, is it a high grossing yield property, or is it a capital gain type property? If it is a capital gain type property, what's the time frame that you think you're going to own the property for? So it's just having all that information to then be able to present that to the bank, so we have that all up front.
Yeah. So be prepared, having information is really the most important two things from the bank.
And engage us early, because, for example, things around like evaluation, for example, we have a process that we do need to follow around valuation, where we will actually instruct the valuer. So that has been a change that's come in the last couple of years. And so if you have a valuation on a property, don't rush out and get one until you've spoken to us, and we can make sure the right person's doing it.
Yeah, can I ask you a good point about the valuations that come in the last couple of years? What was the main reason for it, or was it just purely that the banks like operating with the valuers they know and trust, and not saying there's shady valuers out there? Probably 10 years ago there may have been. What was the main reason? It was more than just a BNZ decision. It
was. We're actually governed by two bodies. The Reserve Bank's one of them, and then we also have APRA, which is the Australian regulator, because we're an Australian-owned bank. So they brought in some further rules around having that independence and that diversity with valuers, and so we needed to adhere to instructing them in that way, rather than the client actually selecting the valuer. So it's purely to take that independence piece and have that lens through it.
Okay. No, that makes sense. And as you said, and I've seen it myself a lot, you need to get in early as possible with the bank to book that, because it does take a process, unfortunately, from the investor side of things. It's a bit of a pain, because it does take time depending on what the market's like and how busy the market is, whether the valuer is even free to do a valuation in a few days' time.
If you already do have a valuation that you may have paid for, may have come from the vendor, for example, we can look at that and sometimes get an exception for that to be utilised, rather than incurring expense of having another one done.
Okay.
But again, it's sort of a case by case.
Yeah. Yep. Obviously, present what you've got. And
talk to us. To us. So we'll obviously try and save money for you wherever possible.
Yeah. All good. Okay. So in the banks or in the branch right now, what sort of rates or deals are your staff recommending people take? And I know obviously it's a hard question, because it depends again on the personal situation, but I mean, where do you see things with what people should be doing?
The mortgage and housing market remains intensely competitive. Every customer and investor will see on a daily basis an ad via TV or via print somewhere or web that banks are offering different rates and attractive rates historically. I guess we would try not to say fix for 1 year, fix for 2 years. What we would try and do is actually work through a customer's short, medium and long-term plan for not only this particular property, but actually their full investment portfolio, whether that be one property or 10 properties plus. That way we can look at a range of options so that they can make an informed decision. We can talk to them about what other customers do in similar situations. So that might come back to things such as interest rate averaging, to not have all your eggs in one basket, per se. But I guess an example I have is something my team did recently. Was a customer was working through a purchasing and automatically came to us and wanted to lock in for 1 year. Now, if we hadn't had that conversation with them, and peeled it back to the plan for not only this property but also the portfolio, we wouldn't have sort of worked out and gone through it with the investor that they actually wanted to sell down one of the other properties within the next 6 months, and some of those proceeds would actually pay down some of this debt. So therefore automatically going and fixing for 1 year wasn't necessarily the right thing for this particular customer. So we were able to have a conversation and do a split portion, some on 1 year, some on 6 months, which then made sure the customer coming into selling that other property wasn't going to have any early repayment costs for that portion.
Yeah, I was going to ask about split loans, because some listeners probably don't even know you can. If you buy $500,000 or you borrow $500,000, you don't have to put it all on 6 months or 5 years. You can, do whatever you want, 200 at whatever 1 year and 300 at 10 years or whatever it might be. A lot of your customers are doing that.
Yeah, that's quite a important way that they can get some of that interest rate averaging. They can work through it, and also what it means is exactly what I spoke about. They've then got the flexibility to be able to pay down some debt if they want to, so that always helps.
Bit of risk assessment or risk management, I guess, isn't it? Especially when the interest rates are very volatile and higher, probably.
And we've also got a product that is an offset account, so for customers that might have a number, quite a large amount in deposit funds or cash flow, they can actually offset that against their loans, and in that instance it would actually be a floating rate. So really, as Jeremy said, it's about having the conversation, because one size is never going to fit all. It's actually your own personal circumstances, and we can then help tailor it to what's going to be best for your business.
Yeah. Okay, obviously the rates are unprecedented where they are at the moment, never been this low. It's only, here's a disclaimer, I'm not saying all this is going to say that lady or bloke at the BNZ said. How long do you see things at the moment? I know it's a question economists have got wrong for years and years, but maybe my personal opinion is going to be like this for a while. I'll say a while. What do you guys think?
Yeah, well, my personal thought is of the same view, Mark. We had a OCR rate last week, and BNZ economists were predicting that it would be cut again. The governor decided to leave it as status quo, but the prediction for June is that all banks are now backing that it actually will be cut again. I think when you look at a lot of the economic factors contributing to particularly Auckland, but then the spin-off to the regions as well around growth, not just in the housing market, but actually in the economy in general, is positive. And so our view, and I know Tony Alexander had said this at a function we were at a few weeks ago, that he views that the same, that rates are actually going to stay low for a period of time. Again, something offshore could happen that could actually affect that. So particularly in China, because it's a big trading partner for us, but also in Europe as well. So
we have a new trading partner of India now anyway, so according to the news last couple of days, so
that's right.
Which is all quite exciting for us. That's great. I know I was at the same event with Tony Alexander spoke, and I mean, but he was talking about, I think it was 9 factors, and he seemed to think 2 or 3 of those factors would have to majorly change for the housing market to be affected sort of in Auckland and New Zealand. You spoke about the volatile world right now, which it certainly is. How do you see any breakdowns in the Europe or Asia economy affecting interest rates in New Zealand?
The global economy and financial system does continue to swell and continues to need close monitoring. I guess they do appear contained at the moment. However, any breakdown in the European economy could affect New Zealand interest rates, the most via high international funding costs. So all banks obviously have a portion of their book that they lend out to customers, which is then funded offshore. So any increase in those funds of cost of funds for the bank, would then mean that cost is inadvertently passed on to the customer. Any major disruption in European or Asian, particularly China, would disrupt the New Zealand economy. I mean, this could mean could be required to reduce the official cash rate even further if the exchange rate doesn't drop. But I guess ultimately the Reserve Bank has a number of different levers available to them to try and contain different parts of the economy, such as things we've seen more recently, like your LVR restrictions or introducing additional asset subclass for property investors.
Right. Yeah. Land tax. We talk about land tax, or is that a no-go for about another 3 weeks till John Key hears all the results from how many people from overseas are actually buying property? It's going to be interesting results that come up there. Those you don't know, it's been for test results. It's been taken about 4 months or 5 months to come through, and John Key's just waiting at the moment to find out the exact percentage of overseas investors buying in New Zealand, and that might affect whether there will be a land tax of sorts. I believe I know he threw a 10% around what I've heard. It's not going to be anything near that if that was ever the case. I know in Australia it's only about 1%, but it's been going on for 100 years over there. Again, that's just one of those, I suppose, things that Tony Alexander spoke about, one of those, just a factor that's not on its own not going to have a great bearing on the property market. Not a loaded question, but that's how I see it. Was that be?
Yeah, I mean, I think New Zealand is one of the few countries in the world that don't have some sort of a capital gain tax or the like. So it'll be interesting to see what does come out with the report.
I suppose just watch this space for 3 or 4 weeks till that report comes out.
It is a little bit of that, and I think what Tony was referring to around the factors, particularly for Auckland, around the shortage of housing, the net migration, those factors are still going to continue, and that demand will still be there. So
yeah, definitely, 100%. Okay, so we talked a bit about loans and banking or what have you. So someone comes to a bank, they buy a house that's a large, whether they're an investor or not, it's a heck of a lot of money they're investing. So what other services can a bank provide to that investor?
Great question. I guess what BNZ, or the way BNZ likes to think about it, is what can BNZ do differently, or what do we do differently that makes a customer walk into BNZ over and above a bank across the road, whether they be red or yellow or light blue. And I guess ultimately that comes down to two things. It's been able to provide that relationship to a customer, and also that specialist expertise when required. So we have a number of tools available for property investors. So some of those are portfolio trackers to help clients be able to go forward and track the performance of not only individual properties but also the wider portfolio. That can be useful when, as I just spoke about earlier, where a customer is actually sitting back and thinking, actually, where am I going with my portfolio? What is my 5-year plan? Actually, I've got a property here which I brought quite early on in the piece of being an investor. Actually, the decision at that point wasn't that great. Maybe I didn't know what I know now. Actually, maybe it's time to move that property on. Maybe I need to put that money into a higher yielding property to help offset some of the other properties I've got which are showing great capital gain. So we think that can add a lot of value. Other tools we have products and accounts such as Total Money or U Money. So they provide a full sort of account product suite where investors can have a separate account for each individual investment and track things that way. Accountants love it. It's easy to track expenses for that one particular property, and also goes back to you being able to have that line of sight of how each property is performing, rather than dumping everything into one account and shuffling that off to the accountant for them to tell you how things are going. Another piece we offer is sort of landlords insurance protection over and above your standard home insurance policy.
Yep.
And that's tailored specifically for property investors to cover damage such as loss of rent or intentional and willful damage and things like that a standard home policy wouldn't cover.
Right.
And I think one of the key things is our people. We've got pretty amazing people that work for BNZ.
Of course.
And they're very, very knowledgeable. The experience that we've got is phenomenal, and it can be quite a lot of complex areas, and they'll actually help clients fight through that complexity and find quite a simple solution. One of the other key things that we offer is actually life insurance, which sounds like a bit of a dull subject, but is actually really, really important for clients to consider. If something did happen to them, how would their family be looked after? So we can actually provide that service as well.
Great, and you've got these wonderful rooms and lounges you can use or run a wee conference and make good coffee. And
absolutely, that's a bonus.
All a bonus. Absolutely. Hey, so sort of before we sort of finish up, what are some of the pitfalls investors fall into that you guys as a bank see?
Wow, there can be a few.
Yeah, and I've seen a heap of lot myself in the last sort of 10 years, so...
Certainly asset type is a big one.
Okay.
So, that's really around doing your due diligence on what sort of property you're buying. Do you have certain plans for that property that then the council plans or unitary plan, doesn't fit in with, or leaky buildings is a big one. So we can actually run sort of weather-tight assessments on certain properties as well, which can help with pre-buying. The big thing really is around getting your structure in place. So talking to other professionals, your accountant, your solicitor, and making sure that you've got that defined up front, actually, before you purchase. Because you want to make sure that you're actually buying it in the right name. We're doing loan documents in the right name, whether that be buying it as a trust, a partnership, or whatever entity.
Yeah.
It can be very stressful trying to change documents the day before you're due to settle, and that can be very costly for you as well, because you may miss settlement, or it's going to be expensive for us to turn documents around very, very quickly. So you don't want to be putting that stress on yourself. Get your team of professionals around you and get your structure sorted early in the piece, and give yourself as much time as possible.
There's probably too many people out there who actually think they can save $1 and by not getting the professionals, but they're professionals because that's their bread and butter. That's what they do every day. They know better than you or an experienced investor.
Yeah, coming back to that due diligence piece, I guess in such a seller-friendly market, buyers can be very quick to want to put together the best offer and try and secure that property. But when you're talking about some of those specialists, your weather tightness, your builder's reports, a big one and topical one at the moment, your P or methamphetamine testing, and there's lots of articles on that at the moment. I guess it's important to make sure you have the right clause in any sale and purchase agreement to ensure you have time to adequately tick off any of those boxes and make sure that anything you're buying isn't going to then, moving forward, have remediation costs that you're going to need to find from somewhere.
Hope you've got a good agent that knows what clauses to put in there to help you out. Very good. Hey, just one thing you mentioned there, unitary plan. Bit of an unusual question, but I'm sure I know the answer of it. Obviously, it's getting closer and closer to happening. If someone comes along to you and go, hey, I'm going to do this after the unitary plan changes, are you not going to worry about, I assume you wouldn't be able to approve anything until the unitary plan actually happens, or do you take into consideration some of the plans that's going to happen when the unitary plan happens or comes in?
So great question. I mean, the valuation will be on the as-is, but we all know that a future possibility is that would very much change the use of that land use. So again, once you're sort of getting into that subdivision territory, we would start to engage our commercial property team, and they've got a lot of expertise around this particular area, right. And they can actually work alongside developers to ensure that they're putting the best package together.
Yeah. Great stuff. Okay, well, before we finish up, any final comments you've got to any budding investors? And I suppose here's your 1 minute sell on BNZ or yourselves.
I guess it's it's an exciting time. It's a pretty dynamic market, and we're just we're here to literally walk alongside clients and actually help them realise their goals. So wherever you are in that property investment cycle, wherever you are in your building your portfolio, we'll be able to find someone that will be able to work with you at BNZ to help achieve those. And we're as passionate about it as is what your audience is. So
Great stuff. Okay. Oh, hey, thanks so very much for your time today, Stephanie and Jeremy. And we will have on the website how to get hold of these people if you need to. So thanks for your time today.
thanks for the opportunity.
Thanks for having us.
We'd like to thank Stephanie and Jeremy for their time today. Hopefully you picked up a few hints and tips on what to do and what you need to do to get some finance moving ahead. So we hope you enjoyed today. We are going to take a break for 3 weeks, and then we have 3 or 4 podcasts all lined up ready to go after that. So we will see you then.